Welcome to another riveting episode of Incompetent Capital, where today we're exposing a shocking display of analyst failure that will make your stomach churn. We've unearthed a group of 5 so-called experts who, with their so-called insights, have led countless investors astray when it comes to CVS stock. These analysts were supposed to provide clarity and direction, but their blunders have only served to confuse and mislead. We'll drag their misguided forecasts into our incompetence court, where we'll dissect their errors with surgical precision. But the intrigue doesn't stop there. As we peel back the layers of incompetence, you'll discover just how deep the mistakes run. What drove these analysts to their catastrophic conclusions? What critical details did they overlook? We'll unravel these questions and expose the disturbing reality behind their flawed analyses. And as we journey through the wreckage of these failed forecasts, we'll dive into a comprehensive analysis of CVS itself. Beyond the sensational headlines and market noise, we'll reveal the true state of the company, uncovering opportunities and threats that these analysts completely missed. Prepare to be both appalled and enlightened as we dissect the real story behind CVS and arm you with the knowledge to avoid such egregious errors in your own investing strategy. This is one lesson you won't want to miss, so stay tuned and see how you can navigate the treacherous waters of market analysis with greater insight and precision. And if you're eager to turn your insights into action and explore a new income stream, consider starting your own YouTube channel. With Tube Magic by Matt Parr, you'll learn how to leverage AI tools to create, grow, and monetize your channel effectively. Matt's course offers step-by-step guidance to help you build a profitable channel, whether you're just getting started or looking to elevate your existing content. If you're ready to take control of your financial future and build a successful side hustle, click the link in the description to get started with Tube Magic today. Order in the court. Your Honor, I call to the stand our first defendant, Charles R of TD Cowan. As you can see on the chart, Charles began his coverage in 2015 and wasted no time, grabbed his pom-poms, and began cheering investors to buy, claiming from the get-go that this company was worth $116 when it was trading in the low 80s, an overbid of around 43%. Unfortunately for Charles, the stock began its first descent down to the mid-40s from here. To make matters worse, Charles played chase with the stock continuing to overbid and reinstate his outperform call. Then, when CVS made its next bull run, Charles continued to chase upwards again, overbidding and screaming to unsuspecting investors that they need to buy this stock. In fact, he continued this horrible pattern even well into the most recent crash of CVS until his very last call, where he literally matched his bid at the trading price of $59 and coupled it with a hold buy call. Really, you can't even call a definitive hold. What is wrong with these people? This ties into our theory previously mentioned that analysts often hold the unofficial position of relationship manager to the corporations that they are supposed to be scrutinizing in their assessments. Well, good job in that, Charles. Management at CVS is likely very happy with you. We find Charles guilty of gross incompetence and relationship peddling, sentenced to 25 years of making trades based only on his professional calls with his own money. Our next financial assailant is Michael Cherney of Leerink. Michael is being charged with first-degree incompetence and copying Charles's ridiculously idiotic moves. Michael began his coverage almost a year after Charles and played the same game of chase and cheer, albeit a little more conservative in some of his price targets. But he did have an extremely weird move that would even leave Charles scratching his head. He changed sentiment in the trenches to market outperform with a 95 bid, only to turn around and flop back to a buy call with an even lower bid. What the hell is this guy thinking? I'll tell you what he was thinking. He looked at the chart and started thinking, oh shit. And then his supervisor probably got a call from CVS management, and he learned that his oversized bonus would be at stake. So he then decided to change back to a cheering position with a lowered price target so he could sleep at night. Absolutely egregious. Guilty as charged and sentenced to a life of manual unpaid number crunching at your nearest investment bank. Our next defendant, Ann Hines of Mizuho, is being charged with 1 count of gross incompetence and 1 count of salary swindling. As you can see on the chart, Ann has been covering this stock for about a decade. She is leading the pack in overbid price targets that chase the stock as she cheers it along. Can you say chase and cheer? The chart speaks for itself. Guilty of gross incompetence. Now let's run the salary swindling ballistics. She is a managing director at Mizuho, and according to salary.com, they make $690 to $1.1 million a year. Clearly, she has much experience, so we'll call it $1 million. So Mizuho paid her $10 million to make a bunch of nonsense calls on a stock that lost people loads of money. Guilty as charged of salary swindling and sipping martinis on the beach when she should have been crunching numbers. Your Honor, I call David M of Truist to the stand. David is being charged with attempted financial suicide. As you can see, David wasted no time jumping in on the chase and cheer party that CVS was apparently hosting, as all the attendees were the silent relationship managers for them and their investment banks that were supposed to be reporting accurate numbers on them. David began with a whopping 53% overbid buy call at 120 when the stock was trading at around 78. He continued the chase and cheer strategy, but did tone down the percentage of the overestimation rather quickly. He continued to chase and overbid until the bitter end and maintains this ridiculous outlook to this day. Management at CVS must be very impressed with this guy. He will likely get the Relationship Manager of the Year award, but unfortunately for him, today he will also be sentenced to a life of unpaid number crunching for his lack of competence with this stock. Our final defendant today, Kevin Caliendo of UBS, is being charged with gross incompetence on this stock. He began his coverage in late 2017 and started a little more cautious than the rest, with a hold buy rating at 79 when the stock was trading at around 60. But he then learned that CVS was paying bonuses to relationship managers who behaved, so he jumped headfirst into the cheer and chase bash with a series of overshot buy calls and ended the series with a neutral lot buy that matched the stock's price of 60 in May of 2024. Guilty as charged of gross incompetence and partaking in the chase and cheer bash. Notice how all of these analysts more or less made the same pattern of incompetence, and how scared they all are to say sell on this stock. But is this because there is something we don't see in the fundamentals, or is there really a sinister thing occurring with this silent relationship manager theory? Let's peel the fundies and find out. Disclaimer: Incompetent Capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. CVS Health, once a leading player in the healthcare sector, experienced a series of strategic and financial missteps that contributed to its significant decline. The company's aggressive acquisition strategy, notably the $70 billion purchase of Aetna, introduced severe integration challenges and burdened CVS with substantial debt. This move, intended to broaden CVS's footprint, instead led to operational inefficiencies and increased financial strain. Compounding these issues, CVS struggled to adapt to evolving consumer preferences, particularly the growing trend towards online pharmacy services and digital health solutions. This failure to pivot quickly enough to capitalize on new market trends left CVS lagging behind more agile competitors. Moreover, the management and board of CVS missed crucial opportunities to address these challenges effectively. Despite clear signals of shifting consumer behavior and increased competition, CVS did not adapt its business model swiftly enough. The company's reluctance to innovate its retail operations, such as enhancing its digital presence and improving customer experience, allowed competitors to gain a significant advantage. Additionally, CVS's failure to leverage data analytics for strategic decision-making meant that it was not making informed choices to drive the company forward. Financially, CVS struggled with rising debt levels, a direct consequence of its costly acquisitions and expansion efforts. This growing debt burden restricted the company's ability to invest in new growth opportunities or respond effectively to market changes. Revenue growth stagnated, and the company's core retail pharmacy segment saw declining sales. Earnings projections fell short of targets, eroding investor confidence and signaling deeper financial distress. These issues collectively contributed to the stock's sharp decline, which should have been anticipated given the mounting financial and operational problems. The stock's tanking was not simply a reaction to market fluctuations, but rather a culmination of management's failure to address and adapt to these significant challenges. Analysts should have recognized the warning signs: rising debt, declining revenues, and operational inefficiencies. The persistent decline in CVS's stock serves as a stark reminder of the critical need for informed and cautious analysis in investment decisions. So, what's the crucial lesson from CVS's saga? First, investors need to be acutely aware of the competitive landscape. With the rise of online sales and e-commerce giants like Amazon, traditional companies like CVS face intense competition. It's vital to assess how well a company is adapting to these market shifts and whether it's keeping pace with competitors. Simply put, if a company is lagging in its digital transformation or failing to innovate, it could be at a significant disadvantage. Secondly, be cautious with mergers and acquisitions. Companies often tout acquisitions as game changers, promising that these deals will drive immense growth and profitability. However, it's crucial to scrutinize the financial health of the acquired company, not just the acquiring company. When a company you're invested in is buying another, thoroughly evaluate the fundamentals of the acquisition target. If the acquired company has poor financials, it could drag down the overall performance of the combined entity. In such cases, it might be wise to consider selling your shares and taking your profits before the deal closes if it is not favorable, or right after it closes if arbitrage is possible, rather than being swayed by overly optimistic projections. This way, you protect yourself from potential pitfalls and ensure your investment remains sound. Today, we've dissected the numerous failures of analysts who led investors astray with their overly optimistic recommendations on CVS stock. From chasing the stock's highs to missing critical signs of trouble, these analysts failed to provide the insight investors needed. We also explored CVS's own troubles, including strategic blunders, missed opportunities, and financial struggles that contributed to the stock's steep decline. The key lesson for investors here is to stay vigilant, understand the competitive landscape, and scrutinize both the acquiring and acquired companies in any merger. Don't be swayed by hype or overly optimistic projections. Do your own due diligence to ensure your investments are sound. Feel free to check out this video for a beginner's deep dive on financial statement analysis, arguably the most important thing you will learn on your investment journey.